A whole lot of stress in Moscow, in the banking sector, at what's left of Credit Suisse, and even in a surprisingly resilient economy. This is Bloomberg Wall Street Week. I'm David Weston. This week, Michael Chae of Blackstone on where the economy is headed and what it means for his business.
Our business model is really made for times like this.
Former FDIC Chair Sheila Bair on what we learned from the Fed's stress tests.
I don't think we should take a lot of comfort from it. There's a lot of work that needs to be done.
And Darren Walker of the Ford Foundation on what the Supreme Court's ruling on affirmative action means for us all.
The playing field tilts towards those who are already advantaged.
Stress, measuring it and dealing with it was the order of the day this week in global Wall Street. It all started in Moscow with Vladimir Putin backing down in the face of a mutiny.
Дорогие друзья.
Dear friends, today I address once again all Russian citizens. I thank you for your endurance, solidarity, and patriotism.
At UBS in Switzerland, it wasn't so much an attempted mutiny as it was cleaning house, with reports that more than half of the Credit Suisse team it inherited will be shown the door.
UBS is preparing to cut more than half of the Credit Suisse workforce that it bought.
Back in the United States, the Supreme Court raised the stress level for colleges and universities trying to make sure they have diverse student bodies.
This essentially ends affirmative action as we know it.
U.S. banks got a report card this week on their ability to withstand stress in the aftermath of the Silicon Valley bank failure.
All in all the banks had passed pretty clean read.
But for those waiting for Fed rate cuts, the stress level, if anything, went up as housing numbers came in surprisingly strong. And Chair Powell over at Sintra, Portugal, wouldn't rule out consecutive rate hikes yet to come.
But I wouldn't take, moving at consecutive meetings off the table at all.
While his counterpart at the ECB, Christine Lagarde, said she's not even considering a rate pause at this point.
If our baseline stands, then we also know that we will very likely hike again.
But for all the stress this week, the markets pretty much took it in stride. The S&P 500 was up another 2.35%, ending the week at 4450, and that is way above the median call of our Bloomberg elves, who are saying by the end of the year it should hit 4100. The Nasdaq wasn't too far behind, up about 2.2% for the week, while the yield on the 10-year was up 9 basis points, finishing the week at 3.83. To take us through what was driving the markets this week, we welcome back Rebecca Patterson, who earlier served as Chief Market Strategist at Bridgewater. Rebecca, always great to have you here. Thank you for being here. So as you look at all that happened, a lot happened this week, actually.
Yeah.
What do you think was driving the markets? Because, boy, the stock market sure liked whatever they saw.
Well, I think there's still a sense out there that there's a reasonable probability of a soft landing, that the Fed maybe have to hike 1 or 2 more times max, but that's largely discounted now, and that everything is going to line up perfectly. A moderation in growth, but not too much, and a quick moderation in inflation that it would allow the Fed to ease significantly next year. I think that hope, and you get some data that supports it, some that doesn't, is what's really leading the stocks higher, largely. Obviously, there's structural issues with AI and how that could help tech stocks in particular and ancillary businesses through new sources of revenue. But I think the macro picture is really these hopes for a soft landing, which I still personally think are premature.
So we're about halfway through the year now, exactly halfway through the year. Did you expect this is where we'd be when January 1 came around?
The beginning of the year, we had the China reopening, and everyone was very excited about that. It happened faster. It was sort of a big bang reopening. I have been a little surprised with the degree of how quickly it's moderated. The fact that we have youth unemployment in China at over 20%. Manufacturing in China is contracting outright now. Services is positive, but just barely. So China is going to need to do more stimulus. And we have the Politburo meeting coming up in July. I think if they do something, it'll be then. But if we don't see something bigger than the incremental steps they've taken so far, and something really aimed at the consumer, building consumer confidence, getting companies to bring people back to work, I think that one keeps moderating. I think the other thing that surprised me so far this year was the strength in tech. I mean, I think everyone's been surprised by the strength in tech. You've still had higher yields this year. You still had Fed hikes. And normally those longer duration assets are going to be more sensitive to that. But I think what's driven it regardless has been the very strong underlying consumer, because at the end of the day, there's still a big consumer and cyclical component to tech stocks. But in addition, again, these structural hopes around AI and what that's going to bring.
As you say, China right now seems to be disappointing, if anything, a bit. We'll see how it plays out the rest of the year. What's the knock-on effect of that, for example, in the United States? I mean, China has traditionally been the source of a lot of growth globally.
Yep.
It looks like it's not going to play that same role. What does that mean for the United States economy?
Well, it's so interesting. I think the U.S. could actually be a small net beneficiary when it comes to the stock market. So again, think back to November, December, January, when we had the speculation and then actual reopening in China. You saw economies that are more sensitive to China, that have stronger trade relationships, business relationships, benefit even more than the U.S. did. So Germany, for example, 50% of their GDP is exports. China's a huge trade partner. Italy, a lot of the emerging Asian economies, commodity prices. So all the capital was going to these more cheaply valued, attractively valued stocks overseas that would benefit from China. Now with China sputtering and people saying, where do I want to allocate for the second half of the year, even though certain parts of the U.S. equity market could be seen very pricey, especially some of those tech names, the U.S. economy still looks more resilient than a lot of places overseas. So one thing that could be a surprise for the second half of the year is that the U.S. outperforms again. It's amazing to say that with tech stocks valued where they are today, and I think that has to slow at some point soon, especially with the Fed continuing to raise rates. But if the U.S. is the best house on the block, and I think it will be in the second half of the year most likely, that might keep capital coming in here, which means a stronger dollar. And so certain U.S. stocks will benefit more than others.
We all pay so much attention to the central banks, not just the Fed, but the central banks. We heard from them this week at Sintra over in Portugal. And certainly we heard a message from Jay Powell from the Federal Reserve, from Christine Lagarde, and even from Mr. Bailey, Bank of England. If anything, indicated we're going to have higher for longer. How does that affect the market?
I think that's really going to be end of the year and early next year story. So again, right now the market is pricing in higher for longer for this year, especially compared to January. January, we're still thinking we could get rate cuts during this year. That's largely been removed, but we're still looking at a market discounting significant easing next year. Now, Jay Powell himself has said that for inflation to get back to 2%, their target, is probably not happening until 2025. So are they actually going to be easing a year ahead of that if inflation's above target? Maybe if there's a huge crisis or if the jobless claims and the payroll numbers deteriorate very materially. But if they don't, it's hard for me to see that easing coming. So I think that is going to be a headwind for equities in the U.S. and globally, probably as we get towards later in the year and the Fed is signaling that we're not there yet.
As a recovering lawyer, I have to ask one quick one about the Supreme Court. We had several controversial decisions come down. Do they have any economic effect, do you think?
The one decision that we got today about the student loan forgiveness, that's not going to go forward, the decision itself is not as economically important, but there is a relative angle to this, which is that student loans have been forbeared, right? They haven't had to pay them since March 2020. And that ends this fall. The Bureau of Economic Analysis is saying $38 billion annual rate of disposable income they had from not paying those loans. That goes away. So I think when we think about what could hurt GDP at the end of the year, Q4, Q1, this could be a material hit for the consumer.
Interesting. I'm not sure we'd figure that out yet. Thank you so much, Rebecca. It's really great to have you with us. That's Rebecca Patterson, formerly with Bridgewater. Coming up, the world of private equity today from the perspective of one of the biggest players. We talk with Blackstone CFO Michael Chae. That's next on Wall Street Week. We're on Bloomberg. This is Wall Street Week. I'm David Weston. Investors these days face a number of real uncertainties about where the economy is going, as well as what the Fed is likely to do in response to that. One of the ways to look at what those uncertainties really tell us and what we should do about it is through the lens of alternative investing. And we welcome now somebody who is at one of the biggest, most successful alternative investment houses that there is. It is Blackstone. He's the chief financial officer there, and he is Michael Chae. So, Michael, welcome to Wall Street Week. Great to have you.
David, it's great to be here. Thanks for having me.
So let's start with a macro here, if we we could. What is the Blackstone view, the operating thesis right now about where we are in the economy and where it's headed, on inflation, on whether we're going to have a big downturn or not?
Sure. Well, on the macro, which obviously affects everything, we do benefit from having the lens of a really big portfolio of investments. So we have stakes in over 200 companies that together have over 200 billion of revenues in aggregate. We have a real estate portfolio with over 12,000 individual assets. We have a very big private credit portfolio. So that's a very sort of rich sample. And I'd start with the good news. So the good news first, I think, is we pretty definitively see inflation trending down. You know, if you look at the inflation prints, the standard metrics, and you adjust for shelter, which sort of lagged on the way up and is now lagging on the way down. If you look, for example, at core CPI, a very important metric, ex shelter, that's running in the mid threes. And if you look at CPI by itself, ex shelter, it actually hit about 2% last month. So we definitely see the direction of travel being down. Other good news is the performance of and resilience of the economy and of many companies to date. So in our own portfolio, we talked about this publicly in the first quarter, our private equity portfolio companies grew at double-digit revenues in the first quarter with stable, resilient margins. We see in our portfolio, clear signs that costs have peaked in the last few quarters, including with respect to wages, very importantly. So there's some good news on both those fronts. Now, against that, of course, is the challenge of the cost of capital and the availability of capital. And there, I think you see the confluence of three really big things. First, obviously, the escalation in short rates over the last 14 months or so, 500 basis points. I think the Fed has basically achieved its goal of achieving positive real rates for the first time in this country in many years. And we're going to take the Fed at its word and plan for higher for longer short rates. Second, quantitative tightening. As you and I know, I think a few years ago, we sort of couldn't stop talking about QT. And now I think we don't talk about it enough. And so pre-COVID, the Fed balance sheet, as you know, was $4 trillion or so. It more than doubled in the subsequent couple of years. And now they're embarking on a balance sheet reduction program where they're basically, through runoff of assets, shrinking that balance sheet by about $1 trillion, annual run rate a year. So that's going to have significant effects over time, and we already see some of the impact in certain markets and how they're behaving, like agency mortgages. And then third, as a result of the banking challenges, especially the regional banking challenges of earlier in this year, we do think you'll see credit contraction from that over time. So those are three big forces, and I think the result of all that is the Fed is basically going to deliver what it intended, which is a slowdown in the economy. And I think, you should expect to see deceleration in the economy, in the coming months.
So take all that together, a complex and nuanced view, strength in the economy, at the same time, reduction in liquidity, some uncertainty. What does that mean for deal making? Because we saw at the end of last year, going into the beginning of this year, it almost dried up. I mean, M&A really went down a lot. What are you seeing at Blackstone?
I think we're seeing the overall M&A cycle playing out probably as we more or less expected even a year ago, which is you had this really big rate shock, again, the 0 to 500 basically in 14 or 15 months. And during that time period, M&A activity essentially froze. We are now seeing on the ground some thawing of that freeze. And I think the reasons for that, having seen these cycles before, are that seller expectations need to be recalibrated, and that takes time. It generally takes sort of 12 to 24 months after a market shock or after a cycle bottom. And so I think that process is playing out. And then in this particular circumstance, I think market participants are now, seeing that we're nearing the end of this dramatic rate increase cycle, and therefore feeling like there's a little less uncertainty, a little more certainty, and are readier to transact. And so if you look at our own business, just in this month of June, we've been busy people. And so in the last couple of weeks, we announced things like a $2 billion investment in one of the country's fastest growing utilities, an almost $1 billion additional investment in the country's largest private developer of renewables. We're financing, in partnership, a potential vaccine for pneumonia. In the logistics area, real estate, which we're big fans of, we've been selling and buying. We announced the sale of over $3 billion of logistics assets to a public company earlier this week, and we also acquired 3 different portfolios of logistics assets in both the US and Europe. So I think those probably constitute green shoots or potential green shoots. I think you'll be hearing that term will be more in fashion this summer, I think, among Wall Street types. But really for us, in terms of our business model is really made for times like this. At its core, we're all about long-term, locked-up, committed capital through fund structures. And what that allows us to be is patient, and it allows us, obviously, to have capital at a time when capital is short. And indeed, we have nearly $200 billion of dry powder to invest opportunistically in the coming time period. And our history has shown that those couple years coming out of a cycle are some of the best times to invest. So we're excited about what the future will bring.
As you look at the landscape out there, where are the investment opportunities, and how dependent are they on assumptions that were done or close to done with the hiking of the rates?
Sure. Well, it's a multifaceted answer, and we have a broad business, and so we have sort of a balanced attack and aren't relying on one single strategy. But I think for sure on the credit side, lending money right now in this environment is a very compelling thing to do with very good risk reward. Probably some of the best risk reward we've seen in a long time in the credit area. So in things like direct lending, you can generate double-digit returns given where base rates are and spreads for being in the very senior-most part of the capital structure with a lot of equity beneath you. So that is very attractive. And other forms of private credit, whether it's asset-backed credit or real estate credit, similarly, it's a very good time to invest from a risk-reward standpoint. So that's one big theme. And then on the equity side, a little bit apropos what I talked about when I went through the deals we're doing, I'd say we're still applying some of our same key themes around sort of the sectors and areas we want to invest in. But now we think we'll do it in a more interesting environment, maybe a somewhat more dislocated environment to find value. So that's really how we're approaching it.
You mentioned real estate. Obviously, Blackstone has a very substantial presence in real estate. It's been a lot in the news. There's a lot of report of the challenges for commercial real estate. What is your perspective on that? Are we headed toward a real substantial downturn in real estate?
Well, it's interesting. I think, when you see the acronym CRE in a newspaper article, you can be sure it's probably going to portray the sector and paint it with a broad brush. And the reality is, there's real bifurcation in terms of the dynamics in real estate as an industry. It's a big industry. You have one sector, traditional office, especially in the U.S., that really does have fundamental challenges and vacancy levels of 20% plus and so forth. That happens to be a very small portion of our portfolio, less than 2% of our global real estate equity portfolio. And then you have a number of sectors where, fortunately, we're concentrated through, I think, some good sector selection decisions, like logistics, data centers, a number of areas in rental housing, life sciences office, where the fundamentals are really quite good. Vacancies in many of those sectors are at 2 to 5%, which is almost at or just above the frictional level of vacancy. Market rents growing at double digits in a number of those sectors. So it really matters where you invest. And the portfolio construction I think our firm has created in real estate over the last decade are really, some of our finest work as a firm.
Artificial intelligence, particularly generative or large language model artificial intelligence, very much in the news these days. Start with Blackstone. What difference might it mean for Blackstone's operations before we get to the investment in AI?
Well, it's a really good question. Obviously, a lot of focus, and we've been focusing on the potential in this area for a while. I'd first, just big picture, say that I believe AI will reinforce and further the advantages of private market investing relative to public market investing.
Why is that?
Well, I think the reason for that is it's actually pretty simple. Public market investing, which relies obviously on publicly available data, that sort of data will be increasingly and further commoditized in an AI world. And in contrast, the value of proprietary data and insights that you can glean from a really large private market portfolio accumulated over many years across many businesses, the value of that sort of information and data and ability to mine insights from that and have pattern recognition coming out of that, both longitudinally and across your business, that will only be further enhanced, again, relative to public market investing. So I think that is a big picture perspective. For us on our business, you mentioned this, first operationally, I think for sure over time, there'll be efficiency gains in our business processes and our operating processes from leveraging these tools. And then on the investing side, which you were getting at, obviously lots of focus. You could say there's a bit of a gold rush mentality right now. We're going to be very careful and thoughtful about how we go about it. But what I'd say is we've already been able to action what I would call some derivative plays relative to the space that we already know are going to be big winners in the ecosystem.
Michael, thank you so much for being on Wall Street. Really great to have you here. That's Michael Chae. He's the Chief Financial Officer of Blackstone. Coming up, President Putin faces a military challenge within Russia, with the consequences far from certain. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. Last weekend saw an attempted mutiny in Russia as the head of the Wagner Group turned on President Putin and threatened to move on to Moscow. Back in 1990, Louis Rukeyser was focused on Russia facing a very different kind of domestic crisis under leadership that was much more popular in the West at the time.
Not so euphoric is Mikhail Gorbachev. And that was one of the market's depressive pills as the week ended. Gorby, whose canonization in the Western media may turn out to have been embarrassingly premature, postponed all meetings with foreign leaders to concentrate on the Soviet Union's whopping domestic problems, a decision that fueled speculation that he might now have a better future in Manhattan than in Moscow.
However markets reacted to the Russian economic crisis back in 1990, they didn't react much at all to what happened last weekend, as explained by our own Michael McKee.
In January 1990, the Baltic states of Lithuania, Latvia, and Estonia were declaring their independence, heralding the breakup of the Soviet Union. Uncertainty about how that would play out sent markets tumbling and bond yields soaring. Ultimately, the USSR dissolved, and Gorbachev fell from power, but the transition was peaceful, which makes you wonder why the reaction was so muted last weekend when another Russian leader found himself challenged over a war, started to reclaim Ukraine, one of those former Soviet states. The quick resolution of the actual challenge may have limited the damage, and the decline of the Russian economy may also have played a role. Russia is nobody's most important trading partner. Oil and agriculture are its main exports. The late Senator John McCain once described Russia as a gas station masquerading as a country. Oil and wheat did seem briefly poised to jump on Friday when the rebellion began, but by Monday had given up those gains and more. Economic sanctions, while less effective than hoped, have still put Russia in a big hole. The economy's been contracting for a year. Analysts say the effects of the short-lived rebellion are still playing out behind the scenes. President Putin could still fall. That would likely have a big effect on markets, worried about who might control Russia's nuclear stockpile. But any concerns likely won't be based on the Russian economy. One interesting thing, though, there are area assets rising in value. Ukrainian bonds. Much of this is clearly distressed debt investors looking to profit, but the rapid rise suggests some optimism about the Ukrainian economy going forward.
Thanks to Bloomberg International Economics and Policy correspondent Michael McKee. Coming up, the Supreme Court rocks the nation once again with its decision on affirmative action. We'll talk with the head of the Ford Foundation, Darren Walker, on what it could mean for all of us.
We are still a highly segregated society in our educational system, our workplaces, our criminal justice system, and other systems in this country.
That's next on Wall Street Week on Bloomberg.
Talent. It's what makes an organization succeed or fail.
This is a business that had built itself on an employee-first culture.
And it's what no organization ever has enough of.
Diversity is the key to success in virtually everything from business to science. We're looking for so many aspects that transcend any one way, but I'm also very worried in states where people are limiting it.
For much of our history, we've left far too much of our talent behind. That includes women, something we still haven't fully addressed at the upper levels of leadership.
I want the best talent. And if you fundamentally believe that talent is created equally, opportunity is not, you'll always ask who's not at the table, who's not in the room.
And then there is the lack of people of color in our universities.
The decline in enrollment has been much larger among men than women, which is, women are doing better overall when it comes to young women getting college degrees, and so this is worrisome. And the pandemic-related decline was especially pronounced among non-white men.
And in our workforce.
If we retreat, that means those of us who are on the front line, we need to make sure we redouble our efforts and invoke those Heschel and King and the leaders of the past to make certain that our best days are ahead of us, as opposed to stagnating today.
But the move to ensure that we have a diverse workforce has met resistance from those who fear they're disadvantaged by giving preferences to others. In a March 2022 Pew poll, 74% of respondents said race or ethnicity should not be a factor in admissions. This week, the Supreme Court responded to those concerns by limiting reference to race in college admissions, posing new issues not only for universities, but also potentially for corporations in their hiring and promotion.
The court has effectively ended affirmative action in college admissions,
potentially leaving in limbo the $340 billion McKinsey reports corporations pledged to invest in diversity and inclusion from May 2020 to October 2022.
We have a lot of talent that wants to come and join us. Like every institution, you make some adjustments around the capacity.
And to take us through what exactly the Supreme Court's ruling this week might mean for talent in this country, welcome now Darren Walker. He is the head of the Ford Foundation. Darren, thank you so much for being back with us. You've written an op-ed piece in the New York Times, a very profound one, questioning some of the fundamentals of the Supreme Court's decision. And let me ask you, because you go through your personal experience and how that informs your view on this, what do you think that the Chief Justice Roberts and the other 5 members of the vote, what do you think they don't understand about America today?
Well, I think what they have not taken into account is the reality that our great history in this country also has some regrettable dimensions. The racism that has regrettably been a part of our country's history, the vestiges of that remain with us. We are still a highly segregated society in our educational system, our workplaces, our criminal justice system, and other systems in this country. And to simply say, in order to stop discriminating, we must stop discriminating, creates a false moral equivalency between those who historically sought to keep the Jim Crow hierarchy, the racial hierarchy that characterized this country for most of our history. Those people are doing the same thing as those of us who have sought to bring about more justice and redress the history, the vestiges of racism that unfortunately remain with us today.
Have we made real progress with what is called by some affirmative action? I mean, we can go back, it's been around for a long time now. Go back to the Bakke decision in 1978. That's a long time ago now. Did having affirmative action help us make progress in the direction we should be making progress?
Well, David, I would not be here with you today were it not for affirmative action. There is no doubt that an entire generation of African Americans and Latinos in this country have been propelled forward in part because of affirmative action. I'm a proud affirmative action baby. I benefited from living in a country that believed in my potential. And even though I was a poor kid living in a rural community, America cheered me on. This country wanted me to win and succeed, and that manifests in the ways in which my public education, the Pell Grants, graduating from college without any debt, all of this made it possible for me to get on the mobility escalator and ride it as far as I could and my talent would bring me. But there had to be a sense of understanding of racial consciousness. And what the Supreme Court and others seem to be saying is that it is time for us to move beyond having any consciousness of race. We're not saying I don't profess to believe that race has to be the deciding factor, but to say that it is unconstitutional to have any consciousness of race and the legacy of racism that remains with us, I think is not good for our democracy.
The Supreme Court's rulings this week came in the context of higher education, 2 universities. There are questions now about how much farther the ramifications may be in the future, and particularly in the private sector. Let's talk about corporations, because a lot of corporations have their own version of affirmative action in hiring, in promotion, and developing of talent. What are the possible ramifications in the private sector for what was decided here with respect to colleges and universities?
Well, there is no doubt that there will be some who will challenge private sector policies around promotion, around the business policies for diversity. But diversity is a business imperative today. No public company, no private company that has customers, consumers, stakeholders, investors can ignore the need for diversity. Now, the research, the data tell us you can't ignore it either. If you want to be a high-performing enterprise, if you want to be an organization that succeeds, you are less likely to succeed, the research tells us, if you are less diverse. So every indicator of success in the economy, in the corporate world, I believe requires looking at diversity.
So race is one form of diversity. It's not the only one. You have ethnicity, you have socioeconomic status, you have religion, lots of different issues, not necessarily with the same history for the United States of America. Are there surrogates? Are there other ways to achieve some of the diversity that you describe without it being specifically race? That is something that's discussed in some of the opinions. For example, socioeconomic struggles that people have had.
I think we should be very sensitive to socioeconomic background. I am concerned in this country about what is happening to working class white Americans, rural people who feel left out and left behind. And we need to absolutely understand the needs of those communities, because we have not done enough to ensure their economic success. And part of the reason for that, their feeling of vulnerability, is because of the growing inequality we have in this country. To your question of is socioeconomic background a proxy, what the Wall Street Journal reveals today in a very good report, they looked at a number of states that had implemented non-race-based criteria, not allowing race to be considered. And in each of those states, the numbers, particularly of African Americans and Latinos, went down, sometimes by 50%. So it is not true, as some have suggested, that by simply finding a proxy for race, we will be able to come back to the levels of enrollment that we saw before. So it is not a proxy. The thing, David, that I also find interesting on this question is those who are fighting so aggressively to undermine racial consciousness in higher education admissions have not, with the same fervor, went after the other ways in which bias is built into the system, most notably the legacy programs that exist at most selective schools in this country that give privilege and bonus points to the children, the grandchildren, the legacies of people who have attended these institutions, who are primarily white and primarily wealthier. This is patently unfair, and yet the opponents of affirmative action have been silent, at least silent in the courts on this issue. And so I think the genuine sincerity that is sometimes voiced by opponents of affirmative action are, in my mind, questionable when they're not as aggressively looking at the other ways the system might be deemed unfair.
Darren, part of what you describe interferes with what we call mobility, ability for people to raise up, the sort of the American dream from the lower ranks, socioeconomically, up to the upper ranks. When you took over the Ford Foundation, you embraced justice as your fundamental tenet. That's what you're pursuing. What can we do to promote mobility? Because I would say that's not just a matter of fairness or justice. It also, in the long run, could help us economically grow our economy more robustly.
We have to have a country where hope is at the center, as it has been for most of our history. The hope, the optimism that has propelled generations of Americans forward. Part of the reason for that hope was a belief that the playing field was fair. And what we know today, David, is that the playing field is not fair. The playing field tilts towards those who are already advantaged and compounds the disadvantage of the already disadvantaged. And so if we want America to be great and to realize its potential, we have to have a fair playing field so that the mobility escalator that I got on is possible in the future. And unfortunately, we know from the research, the data on economic mobility, that there are many other countries outperforming us. If you want the American dream, move to Canada. They are outperforming us on the very idea of what opportunity, equality, mobility means in a country. I don't want America to be beaten by the Canadians on an idea we created, a democracy that is unparalleled in its history and its potential. I want America to be America.
Darren, thank you so much for being on Wall Street Week. That is Darren Walker. He is the president of the Ford Foundation. Coming up, we go over the results of the first bank stress test since all those bank failures back in March with former FDIC Chair Sheila Bair.
The big issue, obviously, is they don't stress high interest rates.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. This week, the Federal Reserve released the results of their stress tests, and all 23 banks passed, I would say, with flying colors. To take us through what we learned, and maybe as important, what we may not have learned from these tests, we welcome now Sheila Bair. She, of course, served as the chair of the FDIC. So, Sheila, thanks so much for being back with us. What did these stress tests tell us about the state of the banking industry?
Well, they told us that in a severe stress scenario, as the Fed has defined it, they would survive quite well and still have plenty of capital to keep lending. But I think there were a lot of problems with the scenario and the assumptions that underpinned the stress test. So I don't think we should take a lot of comfort from it. There's a lot of work that needs to be done. And to its credit, the Fed acknowledged that there are a lot of different potential risks out there that may not be reflected. So I do think we should not take a lot of comfort in this. The big issue, obviously, is they don't stress high interest rates. That is the issue confronting the banking industry right now. And ironically, if you assume, as their stress test does, that rates go back to zero in a severe recession, that actually helps banks that have a lot of unrealized losses on their books, because when you take rates back to zero, those low yielding assets regain value quickly. So in a way, they're rewarding banks for not managing their interest rate risk very well. And that's a big problem. The other issue is that, again, related to interest rates, is what happens if we have a protracted period where the yield curve is inverted, meaning that short-term borrowing rates are higher than long-term rates, which is a situation we've had for a while now. That leads you into a situation which we're already seeing, where banks' cost of funding, what they have to pay on deposits or borrowing, will exceed what they can get on their loans. And that's going to be a real challenge for banks. And those are the kinds of issues the Fed really needs to be thinking about and putting banks through. not this kind of artificial assumption that if we have a recession, rates go back to zero and we start the party all over again and their assets are inflated and they don't have to pay anything on the deposits anymore. That's just not realistic.
How does liquidity figure in? Because one of the issues, obviously, on a lot of these banks that failed is they just didn't have the liquidity, so they had to sell the securities, as you pointed out. Does liquidity factor into the stress test? Should it?
It does not really. There are separate tests on liquidity. They're not public, but they probably should be public, and that liquidity risk needs to be integrated into the capital stress testing because you cannot separate these out. A bank that is perceived to be weak by the market will likely have deposit runs or accelerated deposit withdrawals. That means that they might have to sell securities they weren't planning on selling, the so-called hold-to-maturity securities, which will have a big impact on capital. So these need to be integrated together. You can't just have a clean separation. And again, that's part of the broader interest rate scenarios, liquidity risk, as they impact capital that the Fed should be running these banks through.
We're talking about the banking sector, the regulated banking sector right now. There's a lot of transactions being done outside of that, as you know so well. And if anything, that has been growing dramatically. Ironically, perhaps in part because of the difficulties the banks are having. So they're getting out of some of the business that private credit is stepping into. Is there an effective way to take into account the possible systemic risk from the non-bank banks?
So it's a huge issue because in my experience, we had a lot of non-bank lending during the great financial crisis. They were doing the lion's share of the mortgage lending, right? The big banks were doing the securitizations that fed the beast, but they were doing the lion's share, and they still do, frankly. But those sources of credit dry up very quickly if you get into distressed market situations. The banks that have stable deposits are the ones that keep lending. So if you keep squeezing the banks, and if we overreact, especially with the smaller banks, the regional and community banks, to recent failures, you're going to even push even more of that into the private sector. You're going to constrain their ability, the non-bank sector, you're going to constrain their ability to lend, and that's going to make the system even more fragile. There's also not a lot of transparency between the intersection of the regulated banks and the non-bank sector. Again, this was a huge problem during the great financial crisis. Most of the mortgage lending was at the non-banks, but it certainly flowed back into the banks when troubles emerged. So this is another huge area that supervisors have not been sufficiently focused on. We've been talking about non-bank risk for years. There are tools that were provided in Dodd-Frank to deal with it. They're not being used very well. And, just more scrutiny. And this is more an issue for the larger banks and the interrelationships that they have with a lot of these private equity funds, venture capital funds, other, so-called private funds. Those losses, to the extent those bank customers are going to have problems, that's probably going to flow back into the larger banks as well. We don't have a good understanding of that risk.
You referred to regional banks and also community banks and their role overall in the ecosystem. That's certainly come to the forefront. How concerned should we be about the role of the community banks, the regional banks, versus the big money center banks? And is there something we could do to really ensure their strength? Because they do provide a lot of the lending and the credit to some of the smaller businesses across the country.
They do. And those are the engines of job growth. So, yes, I've been saying for some time now, we need to at least have a temporary guarantee for transaction deposit accounts that these smaller banks have with their business customers and other institutions like, local governments, nonprofits. These are accounts that are used by their customers to pay bills, to make payroll, to bring revenues in, pay expenses. They're operational. They don't move easily. But they're almost always above the insured deposit limits because you got a lot of money flowing in and out to pay expenses, payroll and other bills. So we provided a temporary guarantee for them during the great financial crisis. We were seeing deposit instability then with the smaller banks. Those deposits were migrating to the so-called too big to fail banks. You want to stop that. We've had enough consolidation already. So reinstituting, at least on a temporary basis, this guarantee again, I think would be hugely stabilizing to those regional and community banks. Unfortunately, in Dodd-Frank, for whatever reason, it took the authority away from the FDIC using what's called a systemic risk exception which is an extraordinary procedure, to reinstate that. Now there's a fast-track approval process in the Hill. It needs to be required. The president has to ask for it. The president, for whatever reason, has not asked for it. But I do think there's insufficient focus on stabilizing liquidity for these community and regional banks. The more they have to, pay really high rates on deposits or borrow from the Federal Home Loan Bank, which is really expensive borrowing, the more that is going to distress them and constrain their ability to lend. We need to stabilize those accounts, especially transaction accounts, with a much higher, if not unlimited guarantee, at least on a temporary basis.
Sheila, this is very helpful. Thank you so much for joining us once
My
again. That's
pleasure,
Sheila
David.
Bair. She is the former chair of the FDIC. Coming up, room with a view over Central Park. Another New York icon is on its way back. That's next on Wall Street Week on Bloomberg. Finally, one more thought. Going in style, or better yet, staying in style. The pandemic took its toll on just about everyone and everything, from our health to our schools to our jobs, but much of it is now coming back. Our schools are full again. We're back at work, though that work may be getting done largely at home.
I think since the pandemic, it's a different game now. I think that people now have a choice of where to live.
We're back shopping in stores, at least some of the time. And we are traveling again, as airlines and hotels see their businesses really coming back.
Priorities got shifted during the pandemic, and I think a lot of people rediscovered the joy of travel and also the importance of human connection. And that's really what drove demand. That's why leisure has led the recovery in the hotel business.
With that resurgence comes the return of some New York icons. We've talked already about the opening of the all-new Tiffany's at 5th and 57th.
Don't you just love it?
Love what?
Tiffany's.
This week, we learned that two other New York icons may be on their way back: the Four Seasons Hotel and the Plaza. The Four Seasons, just down the street from Tiffany's, has been closed for 3 years now, and for a time it was used to shelter doctors and nurses caring for COVID patients at the peak of the crisis. The Plaza, once owned by Donald Trump, is now in the hands of a Qatari hospitality company and largely closed to the public, which must have been difficult for a long-term resident named Eloise.
I'm Eloise. I'm safe. I live at the Plaza Hotel, and I am going to the Debutante's Ball.
That is all about to change. Things are coming back in the luxury hotel market in New York City, with occupancy and room rates soaring. And the Wall Street Journal reports that it may be time to reopen the Four Seasons and the Plaza. But if they're going to take advantage of the resurgence, they may want to learn a lesson from a luxury hotel in Delhi and make sure all those occupants are actually paying the high prices that they are asking. The Indian Express reports that a man checked into the five-star Roseate Hotel in Delhi before the pandemic, stayed 603 nights, and simply walked away without paying his $71,000 bill. But he's not the first person to try to get away with a scam.
You're going to get caught. It's like Vegas. The house always wins.
That Indian hotel guest better hope they don't put Tom Hanks on his case. That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.